There is money in your retirement account right now that is quietly following the stock market almost perfectly, and you may never have noticed how little it costs to do it. If you own a 401k, an IRA, or another retirement account, there's a good chance some of your savings are invested in the Fidelity 500 Index Fund. Every day, it quietly tracks 500 of America's largest companies, from Nvidia and Apple to Microsoft and Amazon. But nearly 40 cents of every dollar you have saved is tied to the fate of 10 stocks. Not 500, 10. And in the first 3 months of 2026, that bet got tested in a way it hadn't been tested in years. Yet many investors never stop to ask how it works, why it has become one of the largest mutual funds in the world, or what risks still come with owning it. I know how that sounds. After all, an index fund isn't exciting. It doesn't promise to beat the market. But sometimes the most ordinary investments deserve the closest look. Fidelity publishes detailed fund reports. Morningstar independently rates the fund, and every holding is publicly available. Those documents let you see exactly where your money goes and how closely the fund follows the S&P 500. Pull up Fidelity's own fund page for ticker FXAIX, or the fund's quarterly review dated March 31st, 2026. Every number you're about to hear comes straight from those two documents, and you can check each one yourself. This script summarizes those published facts for educational purposes rather than personal financial advice. Before we get started, I want to make a quick disclosure. I currently own shares of the Fidelity 500 Index Fund that we're reviewing today. I think it's important to be transparent whenever I'm discussing an investment that I personally own. This isn't sponsored content, and I'm not being paid by Fidelity or anyone else to produce this review. My goal is simply to provide an honest, balanced evaluation of the fund's performance, holdings, fees, and risks based on publicly available information. I'll discuss both what I like and what I think investors should watch carefully. As always, this video is for educational purposes only and isn't personalized investment advice. In this video, we will cover 5 main points. We'll start with what you actually own and what it costs. That part is easy. Then it gets more interesting. Stay with me, because number 3 is the one most people never look at, and it will change how you hear the word diversified. And number 5 walks through what happened to this fund during one brutal quarter earlier this year, and what that tells you about owning it at all. One quick note before we start. This video is education, not personal financial advice. Deal? Let's go. Number 1, what you actually own. The Fidelity 500 Index Fund holds 508 stocks from 502 companies, essentially every large company in America. Its job is simple: match the S&P 500 index. Nothing more, nothing less. When you buy one share, currently priced around $260, you own a small slice of Apple, Microsoft, Amazon, Johnson & Johnson, Exxon, Caterpillar, the whole list in one purchase. The fund opened on February 17, 1988, and today it holds about $827 billion. That's not a typo. Billion with a B. It's been run by Geode Capital Management since 2003, and over 99% of it sits in U.S. stocks. Technology represented about 38.5% of assets, followed by financials, communication services, consumer discretionary, health care, and industrials. Its 10 largest holdings include Nvidia, Apple, Microsoft, Amazon, Alphabet, Broadcom, Meta, Tesla, and Micron. Together, the top 10 account for roughly 39% of the portfolio. Rather than trying to predict which company will win, the fund simply mirrors the market. Number 2, the power of low costs. What it costs you. Here's where the fine print actually works in your favor for once. The expense ratio is 0.015%. In plain English, That's 15 cents per year for every $1,000 you invest. Put in $100,000 and the fund charges you $15 a year. Compare that with an actively managed fund charging 1%. The same $100,000 costs you $1,000 every single year. Over 20 years, before you even count lost growth on that money, that's a difference of $19,700. Same market, same stocks mostly. One of them just keeps a lot more of your money along the way. There's also no 12B1 marketing fee, and the fund only turns over about 2% of its holdings each year, which keeps trading costs down too. While returns are never guaranteed, lower expenses leave more of your money working for you over long periods. Number 3, the part nobody checks, concentration. Here's where diversified gets complicated. Yes, the fund holds 508 stocks, but as of May 31st, 2026, the top 10 holdings make up 39.21% of the entire portfolio. NVIDIA alone is 7.89%. Apple is 7.05%. Microsoft 5.14%. Add Amazon, Alphabet, Broadcom, Meta, Tesla, and Micron, and you've covered almost 40% of your money in 10 names. Why? Because the S&P 500 weights companies by size. The bigger the company, the bigger your stake. This fund isn't trying to outperform the S&P 500. Its mission is to match it as closely as possible. And the fund stacks up by industry, too. Information technology alone is 38.51% of the fund. Financials, the next largest sector, sits at just 11.28%. So picture your own account for a second. If tech stumbles, your diversified fund stumbles right along with it. You're not spread evenly across 500 companies. You're heavily invested in a handful of giants, with 498 smaller positions riding behind them. Number 4, performance. How does it actually do its one job? Remarkably well. Over the year ending June 30th, 2026, the fund returned 22.31%. The S&P 500 itself, 22.32%. That gap, 1/100th of 1%, is called tracking difference, and this fund keeps it razor thin across every time frame. 10-year average, 15.49% per year versus 15.51% for the index. Morningstar gives it 4 stars out of 1,201 funds in its category, and Lipper ranks it 3rd out of 100 similar funds over the past decade. Think of it like a shadow. The fund isn't trying to outrun the market, it's trying to match its every step, and it misses by about the width of a rounding error. Past performance never guarantees future returns, but these numbers show decades of remarkably consistent tracking. For investors, that means the goal isn't excitement. The goal is consistency. Number 5, the quarter that tested everything. Owning 500 companies does not eliminate risk. In the first 3 months of 2026, this fund lost 4.34%. Here's how it unraveled. January opened with doubts about whether all that AI spending would ever pay off, though stocks still inched up 1.45%. February brought the first monthly decline since April 2025. Then, on February 28th, joint U.S.-Israeli strikes on Iran set off a war that closed the Strait of Hormuz, the channel carrying roughly 35% of the world's seaborne crude oil. Oil spiked to $120 a barrel. March alone, the index dropped 4.98%. And notice what happened inside the fund. Energy stocks soared 38%, while software companies fell 23%. Microsoft, one of those top 10 giants, single-handedly dragged the fund down by 1.43 percentage points. Remember 0.3? That's concentration showing its teeth. This fund has a beta of exactly 1.00, meaning when the market falls, you take the full hit. no cushion. In 2022, that meant a loss of 18.13% for the year. So let's pause and talk about what those numbers feel like, because that's what actually decides whether an investment works for you. Many investors spend years searching for the perfect stock while ignoring something much more important: staying invested. Imagine someone who put money into this fund the week it opened, back in February 1988. Since then, they've lived through the dot-com crash, when the market lost nearly half its value, the 2008 financial crisis, when it lost more than half, the COVID collapse of 2020, the 18% drop in 2022, and now a war-driven quarter in 2026, with headlines about $120 oil and a possible AI bubble. 5 separate moments when every instinct in their body said, get out. Through all of it, this fund has averaged 11.34% per year since inception. Not because the road was smooth, it never was, but because they stayed on it. Here's the hard part. Somewhere this past March, while oil prices spiked and the news got scary, somebody sold everything near the bottom, and somebody else did nothing, maybe didn't even open the app. By June 30th, the fund was back up 9.97% for the year and sitting near record highs. Same fund, same war, same headlines. 2 completely different outcomes, decided not by intelligence or timing, but by temperament. The numbers in this video tell you what the fund does. Only you know what you do when your balance drops 18% and everyone around you is afraid. Index investing accepts a simple truth. Nobody consistently predicts the next winning company. Instead of guessing, the fund owns America's leading businesses and lets them change naturally over time. Companies that shrink become less important. Companies that grow earn larger positions automatically. That process removes many emotional decisions that cause investors to buy high, sell low, or chase headlines. Successful investing often looks boring because patience rarely makes exciting news. Let's bring it home. The Fidelity 500 Index Fund gives you the 500 biggest American companies in one purchase for 15 cents a year per $1,000, one of the cheapest prices in all of investing. It tracks its index almost perfectly, but understand what you're signing up for. Nearly 40% of it rides on 10 companies, and when the market falls, you fall with it. The full amount every time. The fee is tiny, the ride is not. The Fidelity 500 Index Fund seeks to closely match the S&P 500 through broad diversification, exceptionally low costs, and disciplined index management. None of that guarantees future results, but it provides a clear example of how an index fund is designed to work. Before investing, always read the prospectus and consider your own financial situation or speak with a qualified financial professional. Now I want to hear from you, and I mean a real story, not an opinion. What's the moment a market drop actually scared you? What year was it? How much did you lose on paper? And what did you do next? Put it in the comments. I read every one, and someone watching right now needs to hear that they're not the only one who's felt it.